Stocks finished the expiration cycle, finished the week with a relatively flat day. It's been a flat day pretty much every day. In fact, I saw something that said this is like the longest stretch of like non 1% rallies or declines that we've had in a while. It's been a really kind of sideways week. After last Friday, when we talked about the bear tag on the market forecast, I'm going to show you, and the implications that had, it was really important to see what kind of week we're going to have this week to either follow up on that or not. Heading into a really important expiration cycle that can make or break the Tom Lee rally that is widely expected from a lot of people to get back up to those highs, or whether or not the actual bear market will begin. After this correction, and then a lot of kind of choppiness here over the last little bit. So really important technical setup I'm going to break down for you and kind of show you where we're at and what to expect based off of multiple indicators. A lot of them we've been looking at. Really big move on volatility today. I'm gonna point that out and the significance it has. We'll take a look at what's been driving the market. It was a kind of an interesting risk-off pattern today. And not nearly, I would have expected it. So I'm going to show you that and what that means. And then our trade idea is a stock in a sector that's kind of had it's been so bearish, but it's had a really good run and has some opportunity here because of that bearishness to continue that run. So let's go ahead and get started. Today is Friday, November the 18th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below the video. Also, click the thumbs up icon down there to like our video, comment on anything that stood out to you, join our website at MarketScholars.com for free, follow us on Twitter for more content between the video from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these classes over here on the right. Come down to the bottom, click on this heart. It opens up this tab, hit that like button. Also, same thing with that thumbs up icon. Click on that and click this like button. We hit our goals here. 25 is our goal on Facebook, and 100 is our goal on Twitter. So thank you all very much for those. Again, let's keep that up and see if we can't maintain at least 25 on the Facebook and at least 100 here. You can do that right now while you're watching. It goes a long way for us in helping make sure our content gets out to all of our followers, and also make sure that you continue to get it too, so that based off the likes and shares that you're making shows to them the content you would like to keep receiving. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the rally back up above this little 23% retracement of this near-term rally that we've got. So we had our little pullback. It got below the 23% line. As of right now, it's back up above it with the near-term line also back out of bearish territory. So we avoided getting into a lower reversal zone after this bullish intermediate confirmation signal on Wednesday. It avoided being deeply oversold, even though the momentum line did. And then now we're back out of it and potentially moving back into bullish territory next week. Intermediate line still easily in bullish territory. Market sentiment lines rising, still in bearish territory itself, but rising. And of course, we're still above the moving average by 2.5%. So we're actually looking pretty good. Here, let me get rid of that now so you can kind of see a little bit better. You can see we're still below this kind of 4,000 area that's got a couple Fibonacci lines, the significant ones, the 62%, the 38% on the long-term level, 62% here. Let's look at the Dow Jones Industrial Average. You can see, remember, it's easily up above these lines. There we go. And remember, it's above the 38 and 62 easily. In fact, it's above the 78, and now it's actually holding the 62% of the long-term level. It's actually above the 50 of that long-term move too. So that's easily a good sign. And you can see short-term sentiment did get back into bullish territory today. The Dow is a little bit more bullish. Looking at the NASDAQ 100, you can see here that the NASDAQ here has the intermediate lines up above. It's still kind of at the 38% retracement level as well. Again, remember the S&P is at the 62 and the 38. So it's a little bit down because it hasn't rallied as much. It was interesting. It didn't drop as much here, but it also now hasn't rallied as much. And you can see same kind of thing in the short-term sentiment. The market sentiment line has risen back above 20, so it's still pretty depressed, but at least it's rising and it's out of that reversal zone. And then finally, you can see that was the Nasdaq 100. Here's the Russell 2000. It did not drop as much, and then now you can see it hasn't risen as much. Again, you're also at that 62% retracement, 23% line. The 38 is way up here, where the 78 and the 23 of the long-term bull market is at. So there's, you can see that there's resistance levels, different ones, but resistance levels for all of these, even though all of them are showing dark green shading and a green line. So we have a good bullish move. We haven't had a cluster. None of them have shown a cluster since we've been bullish. It's kind of nice. It's kind of like getting a thrust signal from a volume or a breadth standpoint to get a cluster here to really solidify the momentum that you need to break through a lot of these resistance levels. Because typically when you're on a decline and you're reversing the trend, you got to break through some resistance to get going. So we haven't had that yet, though they're all looking relatively bullish. Let's look at the S&P on the weekly chart since we finished the week. And look at the weekly chart here. Give it a second here to load up. Eventually. There we go. So we talked about that bear tag last Friday and how significant that was, because we either take off from here to the upside and really get going, or it holds like it did earlier this year, and we reverse, and usually it signals the beginning of a bear market. Right now it looks like we're kind of getting kind of a double correction move, because remember, corrections are moves that get you to the 200-week moving average. Bear markets are moves that extend below it and stay below it. So this move actually got us to the 200-week moving average. So you kind of had a double correction move, and as of right now, a double correction bounce. So now the question is whether it will be a failed correction bounce, which is what starts bear markets, or if it's going to be a correction bounce that doesn't fail, that really gets going and moves up to the upside. As of right now, we kind of got a doji. So we've seen this before. We got a doji over here when we got above the moving average. We got a doji over here when we got above the moving average. And so we've seen this before. Good strong move to get us above, and then a doji. Good strong move to get us above, and then a doji. Good strong move to get us above, and then a doji. So, the next week after the doji ends up being relatively bearish. And so we'll see if that ends up playing out again next week, and in this case, the holiday week. The intermediate line is still in bearish territory and rising, and is above its market sentiment line, just barely, but it's above it. But we're not above the 2.5% mark, just like we didn't get either one of these other instances either. So, as of right now, it's still kind of holding, and obviously we're still on this decline, this trend line decline there. Remember, the Dow Jones did break that level. It got the bear tag 2 weeks ago, and it also got a doji the week after, but then it rallied on the week that everything else got its bear tag. And its intermediate line is above 60. So your intermediate line on the Dow is back in bullish territory, just barely, but it's back in bullish territory with very strong short-term sentiment. Again, compare that to SPX, where the short-term sentiment is not as strong. It's bullish, but not as strong, not above 90, but it's pretty bullish. And your intermediate line is still in bearish territory. Your Dow Jones, on the other hand, is much more bullish, right? As you can see, well above 90 over here, and above 60, and market sentiment well above its market sentiment line. On the other hand, so that's the bullish side of things. The bearish side of things is the Nasdaq. So still no bearish tag. I did get one over here, but not one yet. Obviously at lower resistance levels. Its near-term line's barely above 80 this week on the doji. So again, a bearish week next week will just bring that back down. So did not get barely got in the reversal zone at all. Unlike the Russell, which is really bullish, and the S&P, which is at least easily in the reversal zone. And then your short-term sentiment is above its market, or no, it's not above its market sentiment. It's still a smidgen below it, and just barely out of the reversal zone. So that's kind of the bear side of things. Your Russell 2000, remember the Nasdaq's got the biggest market cap stocks in it. Your Nasdaq is also out of bearish territory, also got the bear tag, and as of right now is showing a similar pattern to the last time it got a bear tag. The week after. So we did get above 2%. We got about 3.75% above, and then now we're so far we're weaker. So So again, after last week, we talked about, okay, there's the bear tags that can lead to weakness this week. Most likely kind of a quiet week. Okay, now the week after, now granted, that's only 3.5 day week next week, so we might not get a big range. So we might have timing on our side from a holiday standpoint. But timing wasn't on our side. The last time that we were bearish for the year was 2018. Was right here this week. This week was the week of Thanksgiving in 2018. That was the last time we were bearish for a calendar year, and that particular year we were bearish for the quarter. We'll talk about that here in just a minute. But so you can see there's a precedent, even though seasonality is typically bullish. When we have been bearish this Thanksgiving week, we have been bearish too, and even last year wasn't as bad over here, but last year you can see right here we had a weakness on Thanksgiving week as well that kind of really springboarded, especially on the Russell, springboarded us into the bearish trend that we've been on all year. So from a seasonality standpoint, for the majority of the period, this is a pretty good week. When we're not bullish, though, it hasn't been, and so we'll see. Considering the bear tag. And other things we'll talk about. There's an opportunity for us to be relatively bearish next week, and that's kind of where I'm leaning for things to go. If you take a look at, let's take a look at some of the. I wanted to take one more look here. Let's look at the monthly chart, right? So it's not an end of the month, but it is an end of an options expiration cycle. So we talked about these bull tags and very similar. Respects to the bear tags on the weekly chart, the bull tags in the monthly chart, and you notice again a couple of months ago we had a bull tag, and again it either leads us to a really good bullish bounce, and we were so close in August expiration to really being as bullish as we could be, above that 23% of the post-COVID rally, above the 50% of this year-to-date decline at the time, just barely, because you can see here if I were to move this. Because a lot of people made a big fuss about that. So we were just barely up above right there. You can see the 50% retracement of the year-to-date decline. So, I mean, we were so close there. And you can just see here that bull tag, 2 months from that bull tag, we were looking pretty good. Well, 2 months from this bull tag, we're not looking so good. I mean, we did finish slightly higher, but we're not above the moving average. We're still 2/3% below, and short-term sentiment is not very bullish at all. So that kind of gives you an idea. And if you look at the NASDAQ 100 here, if you look at the NASDAQ 100, you can see very similar. Like we're not above that low point. So 2 months, very similar to where we were over here 2 months after that bull tag. We did have that third month, but 2 months after that bull tag, you're barely above it, and it didn't work out very well. 2 months after this bull tag, we're not even above it. And again, the short-term sentiment's not even out of bearish territory on the NASDAQ 100. So I don't expect it will work out very well either. Again, that's the downside. The positive side is the Dow Jones Industrial Average. Whoops. And you can see it's really bullish, right? We got the bull tag, and now it's very similar to what we saw in August. Almost the exact same pattern to the last time we got the bull tag. Again, on options expiration cycles, right? And you can see just how bullish this is and what happened last time. So you can see what the potential is for this November expiration cycle that begins, or December expiration cycle, that begins on Monday. All right, now let's take a look at the other weekly charts that we typically look at. Here is the 1040 week. The gap is shrinking, so your PPO is rising. That measures the gap. You do have the green arrow still. You got a higher close. You did not close above these last week's high point. At least you close above all these highs, which we didn't do last week. So at least we have some semblance there of some bullishness, even if we're not quite yet above the 40-week moving average. The NASDAQ is not even close to the 40-week moving average. It's barely above the 10-week on a Hakinyashi closing basis, and you can see how low we are still on the PPO within the last 5 years. Let's take a look at the weekly chart for the whole as well. So here's the weekly chart. Actually, that's the daily chart. Let's look at the weekly chart for the whole, and you can again see that bullish candle we finally got this week on the NASDAQ has turned the hull up on the weekly even though we're still well below the 200. And you can see that we haven't flipped that parabolic SAR up. That's the most bearish side. The middle is the S&P, which did flip that parabolic SAR over this week and has been a little bit more bullish here. And then, of course, your Dow Jones Industrial Average, which is actually close to the 200 week. It's way, you see how bullish we are and have been. So this is by far the most bullish pattern. But again, we've seen this before. We've seen this type of stock lead us before. It has been very temporary. Again, when you look at here this chart, and when we look at the Qs relative to IWM, to see kind of how they perform. When this is bearish, it's not good for the markets. And you can see we had a relatively good couple of weeks, but we're still below the 8-week moving average of the ratio. We're still declining on this PPO. We're barely back above the 200-week. Like there's still pretty decent gaps between all these lines. Like we're still pretty bearish there. And then now when you look at it, especially relative to the diamonds, which again is the same concept. When this is really bullish, when this is rising, we're bullish. When it's falling, we're not so bullish. And you can see it's, we're easily still declining here. I mean, we're pretty bearish, but we're declining. And so that kind of gives you an idea of, either, the Qs are going to rally and we're going to be bullish into the end of the year, into 2023, and we're going to feel really good about life. Or this is going to continue to falter and the PPO is going to continue to drop. And the Dow is going to start to fall like it has for most of this year when it filled in that gap with the decline, right? You can see for most of this year, this chart, this ratio has been on a decline as the markets have been bearish. And now we broke support with the markets being bullish. We had that kind of move over here when the markets were bullish, and it kind of led to some bullishness eventually. But it didn't change the trend like we did. We still peaked and we still got bearish. If we are bullish, it'll be very short term. Ideally, it would be back if we can break above these and really get going again. But considering just how long that we have been, or how much the Qs have really outperformed, let's go back as far as we can on both of these. There we go. You can see we've been pretty, like, if we do turn up, there's not a whole lot more to rally. Like, we've trended up from pretty low levels coming off of the great financial crisis low. More than double the ratio, almost triple, actually, the ratio there. And then now we've broken down more than we've broken down in any of these other periods when we've been relatively bearish. So I think this breakdown is more suggestive of more bearishness to come, among other things, right? Let's take a look now at some of the other oscillating charts. So bear with me 1 second while I pull up some of these here. And you can see we're still in bullish levels. It's not really growing, but at least they're still at bullish levels. So that's a good sign. Same thing with the RSI and the CCI. You can see they're still at relatively bullish levels. They're still above, at least it's still above 0, and it's still above 50. You can see it spends more time below 50 and below 0 when you're bearish. So at least you have, if it's not necessarily strongly bullish, at least it's not in bearish levels. If you look at the trend strength indicator, we are still above the cloud. We're not really extending this week, but we are at least above the cloud with a somewhat strong intermediate trend going. And then you look at the the Bollinger Bands, and you can see again, we are still in the upper quartile, barely, and we're at that point of control, but we are in the upper quartile, and the Bollinger Bands themselves are still outside the Keltner channels. They're not really extending away, right? There's not a decent-sized gap here that's breaking away, that's really extending, because you have to get above the Keltner channels for that to happen, and we haven't been above the Keltner channel pretty much all week. Since last Friday is when we broke above the Keltner channel and the band. And since then, we've been below the Keltner channels the entire time and flirting with the bottom of the upper quartile in the bandwidth. So, you can kind of get a sense of a theme here. We've been bullish. We haven't been bearish, but we haven't extended the bullishness. That Arun indicator, which is a visualization of that 4-week chart, Obviously the zero lines hit zero, or the red line hit zero. That's the 4-week low point. This line yet hasn't crossed yet below 70, but it will next week cross below 70, barring a new 4-week high point, which we haven't gotten all week long this week. We got one on Tuesday, but since then we haven't gotten a new 4-week. So as more of this crosses over, and the more that we move up, so now the low point you can see has moved up to all the way over here. So now that the low, as we kind of continue to shrink this range, as you saw there with the Arun indicator again, if I bring this back up, you can see as the range continues to shrink to lower levels, then you'll see that that will open us up for a breakout of that range. And with the green line below 70 and the red line already having hit zero, you would expect the breakout to be the red line hitting 100. So that doesn't have to happen that way. Anything can happen, of course, but that would be the pattern that you'd expect there. Obviously, today itself was a higher high and a higher low, and we closed above yesterday's high, even if we didn't close above last week's high point this week. Very small range, too, this week. When you look at today's range and volumes by themselves, you'll see that we had a range of about a little bit more than half the average range. The volume was up today about average, so nothing too extraordinary there. When you look at the weekly range, or the weekly range, you can see after a range last week of on SPY of 25 points, almost 26, we cut that in half this week. So pretty much half the range, and then the volume after being above average for 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row. This week is our first week with below average volume, and it will be again next week because of the holiday. And the range will probably, depending upon how much we move. Again, if you recall from last year, the range here, this was the range for the Thanksgiving week, and you can see it was average volume, even though it was a 3.5 day week, and we had a 15-point range coming off of a couple of small ranges. So it doesn't have to be a small range next week. The VIX, I had a thread on this on Twitter today. The VIX dropped to really low levels, and you can see from an options expiration standpoint, since this is the end of the cycle, this is a pretty decently bearish trend, and you can see we can follow up with that with some more bearishness next cycle, though this bearishness wasn't as bearish on volatility because we didn't get below 90%. But what really stands out is how low the VVIX has gotten. Right, the VVIX is down to lows that the last. All right, now let's take a look at what's driving this price action. So let's take a look here at the asset class comparison chart, and let's just start off just today alone, and then we'll see how things performed for the week on a relatively flat week, right? But just today alone, you can see the stocks were up, the dollar was up, commodities and the gold were down with that strength in the dollar, and yields were up. So that's been actually a recipe for bearishness, but not today. It's that small cap stocks and large cap, to a degree, the Qs didn't quite make it to positive levels, but SPY did, and IWM made it to positive levels, again, despite the strength in the dollar and pretty much closing at the highs, and yields also pretty much closing at their highs. Now let's zoom out and just take a look at the entire week. And you can see, again, the dollar was up for most of the week, but bonds were, this was one of the best weeks that bonds had. In fact, if I look at the daily price moves here, and let's take a look at just a weekly version of this, you can see like we've had a good few weeks, 3 out of 4 weeks on TLT. It's really starting to turn things around a little bit. If you take a look, we're up to the 50-day moving average. We've been above the 50-day moving average before, but we're pretty high there. We're in the top, 90th percent, 93rd percentile for the PPO is of its 1-year range, so it's pretty strongly bullish. Looking at the 10-year yield, you can see it actually rallied up here today, but it was pretty down for the week. It has been down for the last couple weeks. You can see actually it was slightly higher, even if it was off of its highs of the week, the open. You can see the 3 of the 4 down weeks. But you also see that, this is going to have the 10-year yield is going to have a hard time dropping as long as the Fed's still raising rates and pushing that forward. The MACD is down, stochastic's down, they're turning up. So it looks like we're starting to kind of make a move higher in yields again, and at least in the case for the 10-year, trying to have to catch up to where the 2-year and the 3-month already are. You can see the 3-month is still at 4.25%. The 2-year is at 4.53, and so the 10-year is at 3.83. So you can see there's pretty still significant wide spreads. I mean, these are really, really wide spreads for the 10 and the 2-year. Like, we didn't get this low across some of these other yield spreads. In fact, if I were to look at this chart instead, you can see that. So if I were to change, you can see the yield spread here. Let me refresh this page. And if I were to take a look at the 10-year and the 2-year again and go to a max level, I mean, that's a low level. And it's updated for today at 0.69. Like, we didn't get this low over here, 0.47. We didn't get this low in 89, 0.43. We definitely didn't get that low going into the financial crisis. The last time we got this low was in the late 70s, 80s, again, when we had such significant inflation levels where the Fed was raising rates and was willing to get rates up to high levels. I wanted to show the new highs and new lows updated here for today. Again, not back below that moving average, but you can see it's still negative. Getting that moving average as high as it is now opens us up to a reversal back down below it, like we saw in April here, like we saw in August when things started to turn around. So it's really close. This is a really important week to pay attention to what this index does, as this is getting to pretty relatively high levels for the 4-week average, to see if we end up dropping back down below that, another sign of that breadth that we were talking about. But again, like going back to the inflation discussion, I mean, this is like we haven't dropped from inflation this high without a recession occurring, without unemployment rate going up higher. And assuming the Fed stops raising rates at 5% and we keep dropping at the same rate, this will not even get to zero until like June, and it won't get up into these levels until by the end of the year, assuming inflation doesn't rise again. And if the Fed does stop at 5%, more than likely we probably will get inflation start to rise again next year, unless unemployment really starts to take off. Because as you saw, there's been a lot more discussion of that in the last day or two, which is finally, it's good, because that's the most important thing right now is, the Fed, I mean, the inflation is peaked. Like, the Fed has raised rates fast enough to cause a peak here. More than likely, it's causing a peak. So we know now how fast inflation is going to drop. It will drop about as fast as it rose. So we know that. That's not the issue anymore. It will just keep dropping at that same rate. The issue is whether it will stop dropping at some point and turn back up. And that will be more than likely the case if unemployment rate stays as low as it is without also going up. And that's the problem, right? That's the catch-22 that the Fed sees itself in. It finds itself. Let's take a look at the sector rotation, and you can see if I just look at today alone, you'll notice that utilities were our biggest winner today. Again, on a day that was up, utilities, staples, healthcare, real estate, biggest winners. So safe, risk off, even though we were up for the day. If you take a look at the week that was, staples, utilities, healthcare were your biggest winners. Again, risk off with technology, discretionary way down here, and communication services. Again, that's not the picture we've seen previously, right? If you were to come back to when we started to rally here from 10-12, so starting on 10-13, that hasn't been the biggest gainers since then. So let's go 10-13. It's been a lot of these other cyclical areas, industrials, financials, materials, and energy, and technology kind of matching. And you can see the lagging on XLK and XLY, and they're really lagging now as these safe haven areas are marching higher. Again, that's not the most bullish pattern here. It is for a short term, but it's not the kind of, in a market cap weighted world, that's not the kind of move that can sustain. It will eventually be the kind of move that can sustain a good market long-term rally as these sector weighting disparities resolve themselves through a bear market. But while there still are disparities, then you still need the big ones to be able to continue to lead the way, and that's has not been the case, and another sign that we might run out of gas, just like we have every other time these areas have led the market over the last few years. All right, now let's take a look at our trade idea for today. Let's take a look at Intel. Intel is on my list of what we wanted to make a trade on. You can see it's got dark green shading in the green line, intermediate lines rising, short-term sentiment line is bouncing. So, pretty positive from that perspective. Of course, it's been so bearish. These chip stocks have been so bearish, very, very strongly bearish, that you're starting to rise just a little bit. You got some bullish candles, higher closes, green arrow, rising PPO from extremely low levels down there. You have had 3 green arrows for a good chunk of time. You finally got the 1 red arrow here. So you don't have the 3 green arrows yet, but you've had 3 green arrows for a good chunk of time here. And no pink, we haven't changed. If you take a look at where we are relative to other moving averages, we are kind of in this gap between the 50 and 200 above this node of volume, and we've got a gap in volume up to the next node around $35, and the 200-day moving average is actually going to be higher than that. When you look at its DMI, you'll see that you're above 25 after being so bearish. You're above 25, you're below 20 on the negative indicator when it was the one that was so strong. When you look at the RSI and the CCI, we're above 50. We're working our way up towards 60. We've been above 0 for a good chunk of time here. So you can see how the trend is developing not the strongest trend, but you do have, sorry, I can't see my keyboard. You do have a trend developing. We're not out of the cloud yet, but we do have a trend strength going on. The Bollinger Bands are outside their Keltner channels, but the price isn't quite there yet. At least it's in the upper half of the Bollinger Bandwidth and working its way into the upper quartile. So some good opportunities here for Intel. Not the most bullish, but it's got bullish opportunity potential. We're just lacking, for a directional trade opportunity. So what I decided to do was, okay, well, let's come over here to December expiration. Not the normal expiration, but a week later, just to I already have a trade in our class portfolio and that normal expiration there. And this one actually gives us a better strike potential. We have dollar-wide strikes in this weekly chart. So let's sell the 30 delta, buy the 2 strikes away. It gives us, I think we ended up getting 50 cents, which is 47 cents is the 30% return on risk that we shoot for. You can see the break even actually sets up pretty nice too when you look at the break even on the chart on Intel. So if we were to break the break even, we would be filling in the rest of that gap, which is end up kind of being a runaway gap here. We would finish the rest of that gap. It would reverse it, and we would be in the lower half of the chart below the point of control. Like, we would be bearish. We'd be kind of done with whatever bullish move it's been trying to do the last couple of weeks, and it would be reversing that. And we don't want to be in the trade anyway, even though I'm willing to lose up to $350 out of the 1,000 that I've got at risk. But you can see that as long as we kind of stay in this direction, we're set up okay. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow us on Twitter and like us on Twitter and Facebook. Have a great rest of your weekend, everybody, and we'll see you all next time.